We are continuing from part 1. This is part 2.
I'm tired of this, Grandpa.
That's too damn bad! You keep digging! You'll thank me one day.
What's up, guys? This is OAB with Dig Deep Crypto, letting you know that yes, this is the right place and this is the right time. We are continuing this 2-part series talking about hacks. With this video, we're going to look at the rise of DeFi hacks. Not only that, this article that I have for you has a lot of graphs, a lot of visual aids, and we're going to talk about the graphs. We're going to read a little bit about it, and then we're going to finish it off to look at what the SEC's role is with crypto, DeFi, and how they're going to enforce it going forward. You want to stay to the end because there's going to be some great information and you don't want to miss any of it. As you can see, this article is by Chain Analysis, and we're talking about DeFi hacks and how they are on the rise. This article is from April of this year. Digital thieves had a big year in 2021, stealing $3.2 billion worth of cryptocurrency. But in 2022, they're shaping up to steal even more. In the first 3 months of the year, hackers have stolen $1.3 billion from exchanges, platforms, and private entities, and the victims are disproportionately in DeFi. Our first graph, it shows the total number of thefts and value stolen by victim since 2015 to 2022. You see, 2021 was huge for theft, and they're saying that 2022 is going to be much more. We have the number of theft incidents here. Starting now, it's about 100 in 2022 within the first quarter. We're now going into the third quarter, so it'd be interesting to see where we're at now. Almost 97% of all cryptocurrency stolen in the first 3 months of 2022 has been taken from DeFi protocols, up to 72% in 2021 and just 30% in 2020. So these DeFi protocols are probably using the same code that they were in the past. Now that the hackers are understanding that they're using the same code and they're just making forks of each other, that's why there's an increase, in my opinion, of theft going on within these DeFi protocols. So if you felt safe going into doing DGen and doing DeFi in 2020, you may want to be a bit more cautious now, because this year is really going to ramp up. This graph shows us that there's a percentage of value stolen by victims since 2020 and 2022, and it just gives us a little bit more in depth. And as you can see, not only is DeFi being hit up, but exchanges are really being hit up. To protect yourself, you want to have your private storage. And that's what we see here, that the smallest amount of hacking is going on within the private storage. Code exploits are an increasingly common vector of attack, but security breaches are here to stay. In the past, cryptocurrency hacks were largely the result of security breaches in which hackers gained access to victims' private keys, the crypto equivalent of pickpocketing. Ronin network in March of this year that enabled a theft of $615 million in cryptocurrency has proven the continued effectiveness of this technique. Our aggregate data further illustrates this fact. From 2020 to the first quarter of this year, 35% of all cryptocurrency value was stolen thanks to security breaches. We have code exploits, we have flash loans, they have other, and security breaches. For DeFi protocols in particular, however, the largest thefts are usually thanks to faulty code exploits, and flash loan attacks. A type of code exploit involving the manipulation of cryptocurrency prices has accounted for much of the value stolen outside of the Ronin attack. And we see here that they talk about the percentage of value stolen from DeFi protocols by the attack type. Code exploit being number 1. Flash loans seems to be fading its way out. And security breaches looks like that's what's coming up now. Be sure that when you guys are getting your cold storage wallets, that you're getting it from the proper source. You don't want to go on third-party sites and have your money set up in there, because they're probably set to where you can get your money stolen. I'll read further here. Code exploits occur for a number of reasons. For one, in keeping with DeFi's faith in decentralized and transparency, open source development is a staple of DeFi applications. This is an important and generally positive trend. Since DeFi protocols move without human intervention, users should be able to audit the underlying code in order to trust the protocol. But this benefits cyber criminals too, who can analyze the scripts for vulnerabilities and plan exploits well in advance. In the DeFi hack of Badger DAO last year, for example, the hacker tested the exploit and laundering processes months before the attack. It gives you a little diagram here. I'll have this link in the description so that you guys can take a look at this article. I think this is extremely important. Flash loan attacks, on the other hand, are sometimes caused by DeFi platforms' reliance on unstable price oracles. If you go back and look at part 1, I talk about price oracles a bit, talking about Chainlink, and how there was another protocol, Cream of Finance, to where they say that that was hacked due to price oracles. These are two dangers: inaccurate price oracles and exploitable code. Underscore the need for the security of both. Fortunately, there are solutions to ensure pricing accuracy. Decentralized price oracles like Chainlink can protect platforms against price manipulation attacks. To ensure smart contract security, code audits can steal programs against common hacks like reentrancy, unhandled exceptions, and transaction order dependency. Okay, so the important thing with blockchain and what's coming forward with the regulations, they're really talking about following the money, and that's what happens when they're talking about they're having issues with laundering finances and not being caught. So the question they have here is, how do hackers launder stolen cryptocurrency? In 2021, more stolen funds flowed into DeFi platforms, that was 51%, and risky services 25% than ever before. Centralized exchanges, formerly a top destination for stolen funds, fell out of favor, receiving less than 15% of the total. This is likely due to exchanges' embrace of anti-money laundering and know your customer processes, which threaten the anonymity of cyber criminals. We've created a new category this year to reflect what may be a first in DeFi hacks we've observed: returns. In August of last year, the thief behind a $600 million Poly network hack returned all $613 million of the funds they stole and refused the bug bounty they were offered. So this is where we're seeing the white hat cyber criminals come into play now. Before, they were more black hat cyber criminals wiping out the platform, running with it. Now that these platforms are becoming more advanced and people are being able to get caught a lot easier, they're claiming that they're white hat and they're claiming they're doing it just for fun, but in reality they're doing it to get a piece of that white hat bounty. So this graph here is important. This is pretty cool to look at. It talks about the destination of the stolen funds. We see that in the gray, that was returned. The green were to risky services. The pink is for peer-to-peer exchanges. Gray is blue, so not the light gray, but the dark gray. That's for centralized exchanges. The yellow is the other. Orange is a mining pool, and blue is illicit service. And we see in 2022 that people are putting their stolen funds into risky services. They're also putting it into centralized exchanges, and then they have an other here. That other is probably going to grow for the rest of this year. I would bet that that's going to be the largest one. Once people start to realize where they can put their money and still hide it, that's probably going to be the largest one. Note, risky service refers to services like mixers, high-risk exchanges, and services based in high-risk jurisdictions. Not reflected in the graph above is the law enforcement seizure of $3.6 billion worth of cryptocurrency stolen from Bitfinex in 2016. In February 2022, U.S. authorities arrested 2 individuals who allegedly helped launder the funds taken from Bitfinex during the hack and were able to recover the majority of the total stolen. This is a very positive development for cryptocurrency users, but it remains to be seen whether this seizure will prompt hackers to change their money laundering strategies moving forward. The biggest cryptocurrency thefts of 2021 and quarter 22, the biggest cryptocurrency thefts of 2021 and 2022 of quarter 1. That gives us a list of the different exchanges and the platforms at the bottom. See Ronin, Poly Network, those were the most. Then you have Wormhole, Bitmart, Badger DAO, another undisclosed few. You have Venus, BXH, Cream Finance, and Vulcan Forged. I'm familiar with the Ronin, the Poly Network, and the Wormhole. I've seen Badger DAO and Bitmart. Now I believe Bitmart is in Connecticut. I believe they here in the United States. 7 of the 10 largest attacks over the past 15 months have targeted DeFi platforms in particular. These 7 DeFi hacks have led to the theft of $1.6 billion, while the 3 exchange hacks have led to $960 million. This article here talks about what the SEC, the Security and Exchange Commission, is doing to regulate DeFi risk. So I scroll down here and we talk about the unregulated markets suffer from structural limitations. This is what it says. Market participants who raise capital from investors or provide regulated services or functions to investors generally take on legal obligations. And what may be an attempt to disclaim those legal obligations, many DeFi promoters disclose broadly that DeFi is risky and investments may result in losses. Without providing the details investors need to assess risk likelihood and severity, others could accurately be characterized as simply advocating a buyer beware approach. By participating, investors assume the risk of any and all losses. Given this, many current DeFi participants recommend that new investors exercise caution, and many experts and academics agree they are significant risk. So you see, currently you can get by with DeFi by saying buyer beware. You know the risk that you have going in, and your money can be taken at any time. There's nothing that's regulating the opposite. While DeFi has produced impressive alternative methods of compromising, recording, and processing transactions, it has not rewritten all of economics or human nature. Certain truths apply with as much force in DeFi as they do in traditional finance. Unless required, there will be projects that do not invest in compliance or adequate internal controls. When the potential financial rewards are great enough, some individuals will victimize others, and the likelihood of this occurring tends to increase as the likelihood of getting caught and severity of potential sanctions decrease. And absent mandatory disclosure requirements, information asymmetries will likely advance rich investors and insiders at the expense of small investors and those with the least access to information. Accordingly, DeFi participants currently buyer beware approach is not an adequate foundation on which to build reimagined financial markets. Within a common set of conduct expectations and functional system to enforce those principles, markets tend toward corruption marked by fraud, self-dealing, cartel-like activity, and information asymmetries. Over time, that reduces investor confidence and investor participation. So let's see these next two sections. Who regulates DeFi? In the United States, multiple federal authorities likely have jurisdiction over aspects of DeFi, including the Department of Justice, FinCEN, the IRS, the Commodity Futures Trading Commission, and the SEC. So those are the sectors that are supposed to be able to control DeFi in the future. It says, in spite of the number of authorities having some jurisdictional interest, DeFi investors generally will not get the same level of compliance and robust disclosure they are in the norm in other regulated markets in the US. For example, a variety of DeFi participants' activities and assets fall within the SEC's jurisdiction as they involve securities and securities-related conduct. But no DeFi participants within the SEC's jurisdiction have registered with us, though we continue to encourage participants in DeFi to engage with the staff. They're telling us right there that these DeFi protocols are not under anybody's jurisdiction because they're not regulated or enrolled with these different entities. So in theory, there's all of these different crime networks set up in place, but in reality, nobody is governing this DeFi. There's going to be a lot more hacks coming, guys. There's going to be a lot more hacks coming. You really don't know. So it's extremely risky. So we hear about the SEC Ripple case all the time. We also know that Solana has just been sued. So what is the role of the SEC? As an SEC commissioner, they have the duty to help ensure the market activity, whether new or old, operates fairly and offers all investors a level playing field. I would expect this goal to be one DeFi market participants also support. To do this, the SEC has a variety of tools at its disposal, ranging from rule-making authority to various exemptive or no action relief to enforcement actions. Importantly, if DeFi development teams are not sure whether their projects is within the SEC's jurisdiction, they should reach out to our strategic hub for innovation and financial technology, or our other offices and divisions, all of which have experts well versed in issues relating to digital assets. That sounds good, but we're going to see if there's a new Howey test. We're going to see what comes about with this Ripple XRP and SEC case, because I'm in the understanding that that's going to set precedent of what's going to be accepted and what's not going to be accepted going forward. There's a lot that's going to take place over these next couple years, and you want to be protected. You want to make sure that your funds are protected as well. So, with that being said, for non-compliant projects within our jurisdiction, we do have an effective enforcement mechanism. For example, the SEC recently settled an enforcement action with a purported DeFi platform and its individual promoters. The SEC alleged they failed to register their offering, which raised $30 million, and misled their investors while improperly spending investor money on themselves. Pseudonymity. A second foundational challenge for DeFi is that these markets are vulnerable to difficult to detect manipulation. DeFi transactions occur on a blockchain, and each transaction is recorded, immutable, and available for all to see. But that visibility extends only down to a certain identifier. Because of pseudonymity, the blockchain displays the blockchain's address that sent and received assets, but not the identity of the person who controls it. Until they get that rectified, until we have all of the anti-money laundering and the know your customer in place, DeFi is going to be a dangerous place, extreme dangerous place. And moving to DeFi, they suspect most retail investors are not doing so because they seek greater privacy. They are seeking better returns than they believe they can find with other investments. While some in DeFi believe in absolute financial privacy, I expect that projects that solve this pseudonymity are more likely to succeed in the future, because investors can then be comfortable that asset prices reflect actual interest from real investors, not prices pumped by hidden manipulators. Projects that address this problem are also more likely to comply with the SEC regulations and other legal obligations, including requirements around anti-money laundering and countering the financing and terrorists imposed by the Bank Secrecy Act. In conclusion, their respect for innovation does not lessen their commitment to help ensure all financial markets are sustainable and offer average investors a fair chance of success. DeFi is a shared opportunity and challenge. Some DeFi projects fit neatly within our jurisdiction, and others may struggle to comply with the rules as currently applied. It is not enough to just say it is hard to regulate or to say it's hard to comply with regulations. So they're looking for DeFi to become compliant. Of course, we know that Washington wants to get control, but are they protecting the investor? As of right now, they're not. We're seeing that there's a lot of cyber hacking going on, and in the future, this could be inside jobs, but I definitely believe in the future it's going to be set up to where you're going to have to register, you're going to have to pass audits, your coin is going to have to pass a securities test to be sure that you're complying with all the facets of finance, or that there's no money laundering, there's no terrorist financing. And when this time comes, it's safe to believe that the interest that you're going to be getting on your money is going to become less. It's going to be more people that's going to be jumping into these DeFi protocols, and a place where you was able to get high APRs, you'll be lucky to be able to get 20% what you're getting now within like a CeeLo or something like that. Like, subscribe. I'm going to have more intentional content, looking to not make redundant information that everybody else talks about. And I'm going to be making some more videos here in the near future. Had some stuff going on in my life, took some time away from the computer, but now I'm back. Going to be having a lot more videos talking about what's up to date here in the crypto space. So make sure that you press that subscribe, watch these videos in full, because I say a lot of things, have a lot of information, and you don't want to miss it. Peace.
I'm tired of this, Grandpa.
That's too damn bad! You keep digging! You'll thank me one day.